Let me begin by asking if anybody has any questions. Yes, Mr. Severin.
Just back on the Sherman Act.
Yeah.
I know this is going back to lectures, but the feeling that I got was the intention was so that this act was created so that big companies would beat up on little companies and
Would not.
Right.
Yeah.
And what you're saying is that actually the intention of that act and what it's really being used for don't match up. Is that?
Yeah, I would say that actions are brought by companies that couldn't compete very successfully to stop more successful companies. And apparently, Senator Sherman himself was an advocate of high protective tariffs to protect the very same companies he wanted to protect against the trusts.
Do you feel that some articles in the Act that talk about trying to make sure that these companies don't abuse their powers add some good to our society, or do you think the whole Act should be thrown out?
I think it should be thrown out.
Going back to, I guess, where my question is circling around is we talk about the government being able to protect us against use of force.
Yeah.
And we have these companies growing in size and in power.
Yeah.
What's out there to protect the society from the same thing happening, use of force from these monster companies, from picking on the little guy by teaming up with other companies and so forth?
Well, you see, if you have a large company, that just means a large productive ability. I don't see where at any point that translates into the use of physical force. A large company is not powerful in the sense that it can ring you with more cannon and machine guns. It can just supply you with more and better products.
You don't have to forgive me, I just came out of business law where they talked about companies teaming up, setting up a price that people can't compete against. And so I'm just trying to...
Okay, I know this is the prevailing view, but I think I've shown that to whatever extent you have one company larger than another in the same market, it cannot adopt a policy of predatory pricing. It'll cost it more in proportion to its larger size. Okay, well, tonight and next week we'll be dealing with the subject of the division of labor and the concept of productive activity. This might sound a little bit dry, but actually it has major significance, and it pertains to many of the leading issues of the present time. Yes?
In predatory pricing, we didn't discuss the cartel doctrine.
Pardon me?
In the predatory pricing?
Yeah, we didn't discuss the cartel doctrine for lack of time.
So,
Yeah.
we're skipping that.
Pardon me?
Are we skipping there, or?
No, you're responsible for anything in the assigned readings, even if we didn't get to discuss it in class. Okay, well, as usual, there's a widely prevailing doctrine, this time in connection with productive activity. And that doctrine is that only manual labor is productive. Only manual labor is genuinely productive. Now, you might wonder, well, have you heard this anywhere? Where does this show up? I would say it has a number of very widespread, important manifestations. First of all, let's consider the IRS. You've all had to fill out income tax returns for a number of years, and the IRS makes a distinction between earned and unearned income. What sort of income is held to be earned? What sort is held to be unearned?
Earned is like your wages or salaries.
Pardon me?
Earned is coming from your wages and salaries.
Earned is wage and salary income, according to the IRS, and what is unearned?
Interest and dividends.
Yeah, interest, dividends, profits, essentially anything other than wages. That's held to be unearned. Now, what is the basis for breaking it down that way? Why are wages and salaries thought to be earned, while interest, dividends, and profits and capital gains are thought to be unearned. What characterizes the earning of wages and salaries? What characterizes the activity of the wage and salary earners?
In wage, you work for the wage, but whereas in industrial, somebody else work for it.
It's labor. It's physically working, manual labor of some form or other. And it's on that basis that manual labor is what's truly productive, that wages and salaries are earned. And activity that is not characterized by manual labor, that's considered to be unearned. And this attitude is certainly shared by labor unions, certainly their leadership, and a very large portion of their membership, probably the majority. Who do they think is responsible for the whole income generated in the firms that they're working for?
The workers.
They are, the workers. And that's the basis of their thinking that they have a right to as much of the profits as possible. They think that the capitalists, the bosses, what is their role, essentially, from the perspective of the union leaders?
Them to make as much money. And
Pardon me?
their attitude or their thinking is that management is there to make their own money and to keep them from earning more.
Well, at anyone's expense.
At their expense.
They believe that they are responsible for the earnings received by the management and the owners. They think they're the producers of the entire income, and what non-wage earners receive, they regard as a deduction from what naturally and rightfully belongs to them. So they think that only manual labor is truly productive and truly earns its income. And of course, that's the attitude of all socialist parties and all socialist governments. They think that only manual labor is legitimate economic activity. Now, I'll be out to show that this manual labor doctrine rests on profound ignorance of the nature and requirements of a division of labor society, and in one enormous respect is far too narrow. It's too narrow in terms of the activities that it excludes from productive, namely, first and foremost, the activities of businessmen and capitalists, and also more than that, more specifically, or not getting it narrowed down a little more, the activity of retailing and wholesaling. What is a common term that more or less makes light of and dismisses any kind of productive activity on the part of retailers and wholesalers? Yes.
Oh, they are middlemen?
That they're just middlemen, and who is supposedly easier to get rid of without any loss of anything than the middlemen. They're viewed as performing no genuine productive function, merely as standing between the manufacturer or farmer and the consumer, and adding on their markups. They're not seen as doing anything to earn their incomes. And how is advertising regarded? How is advertising very widely regarded?
An exploitation of the public's naivety and getting them to buy products they don't really want.
Okay, advertising is regarded as taking advantage of people's naivete and ignorance, getting them to buy things they don't really want to buy. It's regarded as inherently fraudulent. Advertising is regarded as fundamentally dishonest. And you often find people saying, when people know what they want, you don't need advertising. Advertising is just to instill baseless, artificial, contrived desires in people that they really have no need for. If they really needed it, they wouldn't need advertising, supposedly. And then what about the financial institutions and the financial markets? How are they typically perceived? Would you expect to pick up the daily newspaper and read laudatory articles about their vital productive role. What's the prevailing attitude toward the financial markets and the financial institutions?
Old school, many people felt that investing in the market was more like gambling with your money.
Yeah, they think
It
at
was-
best it's a gambling
Not
casino.
necessarily a respectable way to earn for your retirement or
Yeah,
earn anything.
they don't think it has any really substantive productive function. At best, it's just a gambling casino, and its activities make no sense. Okay, so these are very widely held ideas, I think. And in these respects, I think the manual labor doctrine takes matters far, far too narrowly, because one should include these activities in a proper concept of productive activity. The activities of businessmen and capitalists, retailing, wholesaling, advertising, the financial markets and institutions, they'd all be certainly included very prominently. And I think these concerns should be of some, these matters should be of some concern to all of you. You're planning to make your life's work in business, and it's very possible some of you are or may end up in one or more of these various lines. And I think you should at least know that what you're doing has some sound objective basis and is not some fundamental frivolity or a scheme of fraud or worse. And I think that's in and of itself a major practical application. Now, there's another aspect in which the manual labor doctrine is actually too broad. It's too narrow in one respect, and now we'll see how in a different respect it's actually too broad in that not even all manual labor is productive. We'll see that now we're getting into point B, money-making and productive activity. I want to establish the fact that in a division of labor society, an essential attribute of productive activity becomes the fact that the activity is carried on for the purpose of earning money. I say in point 1 here, the need for money-making, for activity to be productive in the context of a division of labor society. Now, the way most people think of what represents productive activity, it has no necessary connection to the division of labor, wouldn't see any special connection to money-making. But let's remind ourselves how people live in a division of labor society. Everyone lives by producing or helping to produce just one or at most a very small number of things, and is supplied by the labor of others for practically everything that he himself consumes. All of our labor and effort is going to produce things that we ourselves consume only very marginally or not at all, that other people consume, and practically everything that we do consume is produced by the labor of others. Well, how do we obtain other people's goods and services? What do we have to do to get them to voluntarily turn over some of their goods and services to us? We have to buy them. We have to pay them money. Well, if the activity that we ourselves perform is to be the means by which we can obtain the products and services of other people, what is one of the things that our activity must serve to accomplish? It has to earn money. If we're engaged in an activity that does not earn money, then whatever else it might represent, it is not the means whereby we can obtain goods and services of others. It's not a means appropriate to enabling ourselves to live in a division of labor society. When we think of productive activity and we hold the context that it's taking place in a division of labor society, well, that means it's necessary that the activity make it possible for whoever is performing it to obtain as a result goods and services produced by others. If your activity does not do that, then it's simply not productive in the context appropriate to a division of labor. You need to perform activity that makes it possible for you to obtain other people's goods and services. And the activity that does that is activity carried on for the purpose of earning money. So in the context of a division of labor, money-making becomes an essential attribute of productive activity. And manual labor, which is not carried on for the purpose of earning money, such manual labor is not productive in the context of a division of labor society. Now, these various other activities that I mentioned as wrongly excluded, they are all money-making activities. The activity of businessmen and capitalists, that's certainly money-making. Retailing, wholesaling, advertising, the financial markets and institutions. One of their attributes is that they are money-making, and so they satisfy this criterion that one of the attributes of productive activity is that it has to be carried on for the purpose of earning money. But manual labor, which does not earn money, that is excluded from a concept of productive activity appropriate to life in the division of labor. Now, whether or not an activity is for the purpose of earning money introduces a significant difference into any kind of activity, a difference which is often simply not seen, and I refer here under point 1, application. The maid who works for money and the housewife who cleans the house without earning money. Now, I bring up this example because you might have two people doing exactly the same physical labor. And as a matter of fact, it's very common in textbooks to criticize aggregate economic accounting as it's presently carried out on the grounds that it includes the earnings of paid housekeepers. So all of the earnings of paid housekeepers enter somewhere in calculations of gross domestic product. But the unpaid labor of housewives, which in its physical aspects might be absolutely identical to the labor of paid housekeepers, that activity is not counted. And that's considered widely a shortcoming of the GDP accounts, the gross domestic product accounts. But nevertheless, there is a very significant difference between these two instances of labor, which in physical respects are identical, but there's a major difference by virtue of the fact that one earns money and the other doesn't. And that is the paid housekeeper, her labor puts her in a position to obtain products and services produced by others. The unpaid labor of the housewife does not put her in such a position. And if all we have is the labor of the housewife, which is not being paid, she is not thereby enabled to buy other people's goods and services. The only way she can do so is from an outside source of revenue, some other source of funds. Maybe she has a paying job. Well, that's one source. Or she has to get money from her husband. But her activity in cleaning the house, which is unpaid, that's not a source of funds for obtaining others' goods and services. And there are bigger differences, actually. And this brings us to point 2. If the activity is not for the purpose of making money, then even though from a purely physical point of view it might appear to be producing something, its actual nature is consumption. Physical activity, the physical making of goods, not for the purpose of earning money, actually is inherently consumption. Now, why is it consumption? Well, if you want to physically make anything, where must you start in the context of our life today in a modern economy? Imagine something that you want to make, physically make something.
parts and material.
Yes? What would be something you have made or might contemplate making, and where do you start? Do you recall in your life's experience any physical object that you have produced?
Yeah.
Okay, what would be an example?
Like a shelf in the garage.
Okay, a shelf in your garage. You build a shelf in your garage. Okay, what was the starting point for doing that?
Taking some measurements to determine exactly.
You had to take measurements, and after you took the measurements, how did you start to actually make the shelf?
Purchase some wood.
Oh, you had to go and buy the material, the wood for the shelf, perhaps paint or varnish. At some previous point, you had probably bought a screwdriver. Maybe now you had to go and buy some special screws or whatever. The essential point is that in a division of labor society, we don't start producing anything from scratch. We start by purchasing previously produced products. Every act of production in a division of labor society begins with previously produced products, which we obtain by means of purchase. So an outlay of money is the starting point of all physically productive activities in a division of labor society. Okay, well, what happens to whatever it is that you're producing? What happens with the passage of time, or in many cases, another example of the same point, probably starting even today or tomorrow, I'm sure many of you are going to a Thanksgiving dinner. Maybe it's in your own home, and there are housewives all across the country who have started with outlays of money to buy turkeys and all of the side dishes and so forth. And earlier on, when you bought your house or apartment or whatever, you bought an oven, or you're paying rent that covers your use of the oven, and a refrigerator and all this. So there are outlays of money involved. And what happens to these things that are purchased for a Thanksgiving dinner? They're used up, they'll be gone, and then they are gone. The money that's been expended for them, that's gone. And the same thing is true of the shelf that you've built. It just takes a much longer time. The point is that everything that's purchased, even though it's used in production, the means purchased are used up in producing the product. The product itself gets used up. At some point, what is necessary in order to continue the same sort of activity, to repeat the same sort of activity?
We have to have earnings or money to be able to purchase.
You have to make fresh purchases. You have to make fresh purchases. But if your activity is not for the purpose of earning money, will that activity make it possible for you to replace the means of production that you have used up in the course of that activity? No. So what is the nature of the activity?
Consumption.
It's consumption. Now just think, there's certainly a lot of physical labor in making a Thanksgiving dinner, and a turkey, a cooked turkey is certainly a product. Maybe there's elaborate pies and dishes and so forth. These are products, but it's in its nature a consumptive production, because in order to produce these things, materials, equipment, machinery is used up or worn out, and the activity itself does nothing to make possible the replacement of the means used up in the course of it. So it's consumption. Now contrast that with the activities of a firm, let's say, manufacturing bookshelves. The firm manufacturing bookshelves, it has to buy lumber too, right? And it has to buy tools and equipment, and it will also be paying workers. So it's expending a lot of money, and it's producing a product. In order to produce the product, it's used up materials, paint, varnish, the wood, etc. But how does this differ from someone constructing a shelf in his own garage?
This is how they earn their money.
They're selling.
And they will sell the product, right? And then, having sold the product, what will that put them in a position to do?
Reinvest into building.
They can repeat the activity. They take in, through the sales revenues, the means of going and buying replacement materials and ultimately replacement machinery and equipment and anything else that they might need. Similarly, restaurants that are serving Thanksgiving dinners, they've made expenditures. They use up their turkeys, the means of making the yams and whatever, but they're taking in money from paying customers, and so they are in a position to replace what they've used up. And this is a vital difference. Activities carried on for the purpose of earning money make possible the replacement of the means used up. Activities not carried on for the purpose of earning money do not make possible the replacement, and so they are consumption. The one is self-sustaining, the other is consumption. And I've already said physical production, when the purpose is not money-making, is consumptive production. Yes, Mr. Underwood.
So I can see how this applies to a manufacturing firm,
Yeah,
but to a service-oriented firm,
Yeah.
because their service is geared toward making money,
Mhm.
it would not be deemed consumption-driven, is that correct?
but no business is consumption. I mean, they're
Well,
using,
From a service-oriented
yeah.
firm.
Well, even
Because they are in the process of making money,
Yeah.
it would not be deemed consumptive.
well, they're not. All right, that's true. They're earning money, and they're also they're physically consuming things, which the earning of money enables them to replace. So when you incorporate the fact that they're earning money, it's not consumption. It's an activity that's self-sustaining. And service industries use things up. Suppose you have a barber shop. A barber shop, what's happening to the useful life of its chairs, scissors, combs, brushes, the shaving lather? It's using up at least the productive capacity of its facilities, of its fixtures, equipment. The building is aging. Now, they're not using up a hell of a lot in the way of materials, but a little bit, like they use up hair tonic, they use up shaving cream, so maybe shampoo, but that's not very big in their operations, not nearly as big as in manufacturing. All right, well, very closely connected to this discussion so far, we can make a distinction between two types of expenditure. Depending on the purpose for which the expenditure is made. One is productive expenditure, the other is consumption expenditure. Productive expenditure is expenditure for the purpose of making subsequent sales, for the purpose of bringing in subsequent sales receipts, and implicitly at a profit. There would be no rational reason to buy for the sake of subsequently selling unless you intended to sell for more than you had bought. If your intent were just to break even, well then you might as well skip the expenditure, just hold the money, you're already even. If you're spending money for the sake of bringing in money, the only reason for doing that has to be that you're intending to bring in more money than you expend. Now, so productive expenditure is expenditure for the purpose of making subsequent sales, implicitly at a profit. Consumption expenditure is expenditure not for the purpose of making subsequent sales, for any other purpose. It can be for any other purpose, just so long as it's not for the purpose of making subsequent sales. So you might make an expenditure because you'll enjoy the result. You might make an expenditure because you think it's the will of God. You might make an expenditure because you want to glorify your country or whatever. Whatever is the purpose, if it's not to make subsequent sales at a profit, it's consumption expenditure. If it's for the purpose of making subsequent sales at a profit, it's productive expenditure. And there are huge practical differences, which we've really already seen to a considerable extent. Productive expenditure is self-sustaining. the activities that center on productive expenditure are self-sustaining. In what sense are they self-sustaining?
And as you bring in the revenue, you reinvest it.
Yeah, you can repeat the activity. So a restaurant that buys turkeys for Thanksgiving or whatever, it uses up those turkeys, but it takes in funds that enable it to repeat the equivalent process the next day. A restaurant that's making roast beefs, it buys roast beefs. The roast beefs get cooked, they're used up, but the restaurant collects money in exchange and can go and buy replacement roast beefs. The housewife who's making a roast beef dinner, her roast beef is used up, and her activity does not provide the funds to buy a replacement. It's consumption. And an inherent attribute of business activity is that it is self-sustaining, unless it incurs losses. If you have any modestly successful business, is one which is in a position to be self-sustaining. It expends money, but in the sales revenues it brings in not only the equivalent of the money it spent, but to whatever extent it has a profit, more than the money it spent. And just think, a profit in essence means that you're taking in more in sales revenues than you expended to earn those sales revenues. The money that you expended to earn the sales revenues, what is that?
Cost.
That's your cost. Well, to the extent that you have a profit, you're taking in more money than you expended to earn the sales, and that will not only permit you to expend funds equivalent to your costs again, but to expend more than that to the extent you have a profit. So business activity is self-sustaining and more than self-sustaining. It's not only self-sustaining, it's on net balance a source of additional wealth that enables you not only to replace, but more than replace, or for you yourself to engage in consumption expenditures. Business activity sustains itself and provides the means either for expansion or for its owners engaging in consumption of their own. Now, I say the one is a using up of wealth, the other is a source of wealth. To take a concrete illustration, suppose we had two brothers, both of whom receive an identical inheritance on the death of their father, let's say. And now here we are, the two brothers begin on day one with an identically equal inheritance. And now we assume that one of them uses his inheritance to make what I've called productive expenditures, buying for the sake of selling at a profit. The other uses his inheritance to make consumption expenditures. He is buying not for the sake of selling at a profit. Where should we expect to find them in terms of wealth 6 months or a year later?
Productive brother would be doing better.
The one who's used his inheritance to make productive expenditures, we should expect that he has maintained his inheritance and most likely increased it to the extent that he's earned any profit or interest, and the other one will have dissipated his. The most that he will have left is the resale value of the things that he's bought, if there's anything left of them. So one grows richer through productive expenditure, the other grows poorer through consumption expenditure. Now, this same distinction, based on the purpose for which money is expended, this provides the basis for distinguishing in point 4 between capital goods and consumers' goods. Capital goods are goods purchased for the purpose of making possible subsequent sales. Consumers' goods are goods purchased not for the purpose of making possible subsequent sales, but for any other purpose. Now notice, when I say capital goods are goods purchased for the purpose of making possible subsequent sales, that does not require that you're intending to sell the specific things purchased. A manufacturer buys machinery, he buys raw materials. What is it that he's intending to sell? Is it those things that he's bought? He's intending to sell the product He buys these things for the sake of subsequent sales, but not of them, of the product that they will produce. But they are capital goods. It's not necessary that you be intending to sell specifically the thing that you bought. It's sufficient that what you bought is used in the production of something that you intend to sell. And consumers' goods are things that you purchased that you're not using for the sake of bringing in subsequent sales.
So it wouldn't just be the manufacturing equipment, it would also be the raw materials that would be
So it would
considered?
be all of the materials too, not just the equipment, but all the materials. And not just in manufacturing, throughout business. For example, when a supermarket buys breakfast cereals, what's its motive in buying the breakfast cereals?
Sell it at a profit.
To sell the breakfast cereals. So how would we classify the breakfast cereals in the warehouse or on the shelves of a supermarket?
Capital goods.
They're capital goods. They're capital goods. These are goods purchased for the purpose of making subsequent sales. Now, when the same good passes in to the possession of a housewife who is buying it not for the purpose of making a subsequent sale, what does it become at that point? A consumer's good. So the one and the same good is a capital good up to the point of its sale to a buyer who is not using it for the purpose of making subsequent sales. Then it's a consumer's good. And the vital distinction applies. The supermarket, in buying breakfast cereals, is in a position to obtain replacement funds for the purchase of fresh supplies of breakfast cereals, and more than replacement funds to the extent it earns a profit. It can then expand its operations or pay dividends to its owners who are able to consume the proceeds. The housewife is not in a position to buy replacement cereals by virtue of her purchase of the cereals. It does not provide her with the money to do so. Now, the same distinction as between capital goods and consumers' goods can apply to labor. We can distinguish between two sorts of labor. This is from the perspective of the employer now, not from the perspective of the employee. From the perspective of a wage earner, from his perspective, his labor is simply productive. It's money-making, so from his perspective, we should view it as productive. But we're looking now specifically from the perspective of the employer. And the employer can be employing labor either for the purpose of himself, the employer, making subsequent sales, or not for the purpose of himself making subsequent sales. In the one case, we would call the labor producer's labor. That's essentially, that's the counterpart of capital goods. In the other case, it would be consumer's labor. An example of the difference, you might have a maid. In one case, the maid is employed by a hotel. A maid employed by the hotel is employed for the purpose of contributing to the hotel's ability to bring in paying guests. And so the wages that a hotel pays a maid are the source of funds coming into the hotel, which will make it possible for the hotel to continue the maid's employment. The wages of a maid paid by a housewife are in a different situation. Those wages do not provide, are not the basis of the housewife's earning money with which to continue the employment of the maid. It's a using up of the housewife's funds, not a source of funds. Now, the critical difference in all these cases is the purpose for which the funds are expended, not the physical nature of the activity. It's the purpose for which the funds are expended or advanced. That's what's critical, not the physical nature of the activity. You can have very heavy machinery that represents consumers' goods. We've been talking about turkeys and roast beefs, but let's move on to more complicated things. What is the status of a sewing machine? That's a fairly complicated piece of machinery.
Depends on its use.
It depends on the purpose for which it's purchased. Now, a sewing machine purchased by a housewife for the purpose of making clothes for her children, perhaps, that's a consumer's good. A sewing machine, possibly the identical model, purchased by a dress company, that's a capital good. And what's the practical difference? Well, the housewife's sewing machine is used up and worn out. Ultimately, it will have to be replaced. Is the children's wearing of their clothes and so forth a source of funds for replacement of that sewing machine? No, it is not. But the sale of the dresses or whatever by the dress company, that's a source of replacing the machinery. So that's self-sustaining and a source of funds. The other is not. Now, we don't have to be stuck with examples of housewives. Let's move on to bigger types of machines. There are some home hobbyists who might have a lathe and a bandsaw in their garage, pretty complicated woodworking equipment. And maybe they use it to make chairs and other items of furniture that they use around the house, or they give away as Christmas gifts or whatever. What's the nature of those machines? They're consumers' goods. Now, moving on to a still bigger scale, the Army Corps of Engineers probably owns some of the biggest, mightiest construction equipment in the world. But from the perspective of the purpose for which they're purchased, they are giant consumers' goods. Why? Well, they're used up and worn out in the course of their use. And when it comes time to replace these things, will the Army Corps of Engineers have obtained the funds required to do so by virtue of the use of these pieces of equipment themselves? And where will they have to get the money?
Taxes.
From the government, which gets it from the taxpayers. So you can have a massive machinery, which is consumers' goods. It all depends on the purpose for which they're purchased. And the same distinction can be applied to loans. There are producers' loans and consumers' loans. Producers' loans are loans taken out by business firms for business purposes. If they're taken out with intelligence, the use of the funds borrowed will serve to bring in revenues and profits that will make possible the repayment of the principal along with the interest and more besides. They'll yield a profit over and above the principal and interest payments. Loans not taken out for business purposes, but for anything else, such as to buy your personal automobile, to take a vacation, whatever, these loans do not provide the funds with which to pay the principal and interest. They're consumers' loans. They have to be paid from a separate source of funds, such as the wage or salary you earn from your job. Now, I'll pass over a few of these narrower observations and simply go to point 5 with respect to Adam Smith. Adam Smith very correctly understood these issues, and he was well aware of the nature of government spending, as we'll see. He had the essential distinction clearly in mind, the purpose for which the expenditure is made, the purpose for which someone is employed. Even though alongside of that distinction, he introduced a second, essentially irrelevant distinction for distinguishing between productive activity and activity that is not productive. And that was the question of whether or not a tangible physical product resulted. And let us turn to Adam Smith for a moment. And I'd appreciate it if someone would be kind enough to read this quotation right here over in the left-hand column.
There is one sort of labor which adds to the value of the subject upon which it is bestowed.
Yeah.
There is another which has no such effect. The former, as it produces a value, may be called productive. The latter, unproductively. Thus, the labor of a manufacturer adds generally to the value of the materials which he works upon, that of his own maintenance, and that of his master's profit. The labor of a menial servant, on the contrary, adds to the value of nothing. Though the manufacturer has his wages advanced to him by his master, he in reality costs him no expense, the value of those wages being generally restored, together with the profit and the improved value of the subject upon which his labor is bestowed. But the maintenance of a menial servant never is restored. A man grows rich by employing a multitude of manufacturers. He grows poor by employing a multitude of menial servants.
Okay, thank you very much. I think I added the italics there. Now, Smith clearly has in mind the distinction of whether or not someone is employed for the purpose of bringing in revenue or not bringing in revenue. It's only because revenue is brought in that the employee really costs the employer no expense because he's getting the wages back. But he also has this other irrelevant criterion of whether or not a tangible physical product is produced. Now, can anyone think of a case where some tangible physical product is produced and yet you're growing poor by the operation? You're employing workers to produce a tangible physical product, but they're not bringing in any money for you.
If you're selling below cost.
Well, if you're selling below cost, you'd have a loss, but at least there you still have the purpose of bringing in money. You still have a purpose of bringing in revenue at a profit. Are there any instances in which people are employed to produce tangible physical products and no money is brought in? You can't imagine one. Pardon me?
An army?
An army. I think that would be a good source for examples. Imagine we have 10,000 soldiers digging a line of trenches. The trenches are a tangible physical product, aren't they? Does that bring anything in? No, it doesn't. Now, maybe you might argue, well, a trench is not really a product. Well, I suppose the Navy owned a shipyard. And I'm sure in some countries, navies do own shipyards. And imagine that in this shipyard, a massive battleship is being built. And this is quite an impressive physical product. You have a massive hull, huge sheets of armor plate, and they're paying people to construct this enduring physical product that might be around for 50 years or more. Well, does this serve to reimburse the Navy for its outlay of money to employ the welders and the other ship workers? No. So what's the nature of their employment? It's consumers' labor. It's consumers' labor. The sheets of armor plate, the construction equipment, all of it's consumers' goods. All of it's being used up, worn out, and when it comes time to replace, this activity can't contribute to the replacement. It's consumption. So we have cases here where tangible physical products result, but it's not productive activity. It's consumption. More common examples might be a homeowner works on his porch, or Mr. Feldman is building a shelf in his garage. Well, that's tangible physical products. Maybe he would hire a carpenter to do it, but it's still consumption expenditure. Now, on the other hand, can any of you think of cases of the employment of what Smith calls menial servants, where an employer can grow rich by virtue of their employment rather than simply using up funds?
If they developed land, if it was farming?
Well, that's not menial servants. That would be
servant?
Pardon me?
That would be servant?
No.
Maid service?
Maid service by a hotel. Just think of the employees of a hotel. Wouldn't most of them fit under the heading of Smith's menial servants? Does a hotel lose money by virtue of employing those people, or make money?
Make money.
Make money. What about a restaurant? It employs waiters. There, Smith would call them menial servants. What about a theatrical company? It's employing musicians, actors, actresses. Is there a tangible physical product from their work, apart from possible recordings? No. Ms. Fox.
I wanted to go back to his example about agriculture and,
Yeah.
and doing the land. What if you have migrant workers picking the crop?
Yeah.
I mean, wouldn't-
They're not servants. They're just migrant workers. They're farm workers. Yeah.
Just back to the consumption, he brought up like the.
Yeah, wait, let me back up. When Smith uses the term menial servants, he means to contrast them with people producing a tangible physical product. People who are performing a service, a servant performing a service. Yes, Mr. Timotei.
Just back to you were saying naval shipyards, they build a ship and they're just consuming this stuff. I mean, in reality, though, they are providing a service for us as far as protecting us, so then they will generate money from the government and receiving more funds, so.
Oh, no, let's look at the nature of the government. The government is the party spending this money, right? It's the government that's paying the bill to construct the battleship, right? And the government has a massive payroll. I think throughout the United States, at the federal and state and local level combined, I believe, I might be off somewhat, I think there are altogether about 16 million government employees. How would you classify these as between consumers' labor and producers' labor, and why?
Well, I would think they're all producers' labor.
Okay, well, the government expends their wages. Now, does the government then take in replacement funds by virtue of their activity? Is it the case the government has employed 16 million people? They now go out and they do things for which people pay money that gives the government funds sufficient to continue the employment of these people and purchase whatever else may be necessary.
Well, in reality, it's your taxes
It's their taxes. Now, why does the government need taxes?
in order to fund those projects.
Because the activities themselves, they don't fund themselves. The government's activities are consumption activities. The government spends money. That money is used up and gone. So what must the government do for round two? They have to go to the taxpayers. The government needs taxes precisely because it's a consumer. If the government were in the nature of a business firm, well, conceivably, they might get their initial capital by a tax. Well, then they would have had to tax us once, and we'd never hear from them again because they'd be constantly recovering the funds in the sale of the products or services. But that's not the way it works. They're producing things, hardly any of which bring in any money, and what does bring in money rarely brings in enough, or could bring in enough, to cover the necessary outlays. So government expenditure should be classified as a major subcategory of consumption expenditure. And this is Smith's next essential point. And I'd appreciate it if we could get another volunteer to read this paragraph. It starts here and then continues on to the top of the right-hand column.
The labor of some of the most respectable orders in the society is, like that of menial servants, unproductive of any value, and does not fix or realize itself in any permanent subject or vendable commodity, which endures after that labor is past, and for which an equal quantity of labor could afterwards be procured. The sovereign, for example, with all the officers both of justice and war, who serve under him, the whole army and navy, are unproductive laborers. They are the servants of the public and are maintained by a part of the annual produce of the industry of other people. Their service, however honorable, how useful, or how necessary whatsoever, produces nothing for which an equal quantity of service can afterwards be procured. The protection, security, and defense of the Commonwealth, the effect of their labor this year, will not purchase its protection, security, and defense for the year to come.
Okay, thank you very much. So the essential reason is the government has expended the funds. These guys have done their job for the year, but now there's no money. And so the government has to collect fresh taxes to make possible a continuation of their services. So it's their essential. This is consumption. Now, Adam Smith, I think, was very, very good on the identifying the nature of government activity as consumption, and very, very good in making the basic distinction between productive and consumptive activity. But in a different respect, in connection with the concept of productive activity, Smith's ideas were actually pretty horrendous. And Smith is largely responsible for the great influence of the manual labor doctrine. And I'm going to jump ahead to that. I make a reference here. Adam Smith, very bad on the questions of the legitimacy of profits and interest and on the productive role of businessmen and capitalists, as we'll see under point D. Well, I'm going to jump to point D, so we'll see that. Smith provides the framework of the Marxian exploitation theory. And let me develop this framework, and in the course of this evening, we'll also develop the substance of the exploitation theory and see its tremendous influence in the present day. But to start, we need to have some more quotations from Smith, some more reading of passages from Smith, and let's get someone to do that. This time starting over here. Mr. Zink?
Yeah.
Thank
In
you.
that original state of things, which precedes...
We'll start with the one paragraph back.
Oh, I'm sorry. That part where it says produce of labor?
Yeah.
Okay. The produce of labor constitutes the natural recompense of wages or labor. In that original state of things, which precedes both the appropriation of land and the accumulation of stock, the whole produce of labor belongs to the laborer. He has neither landlord nor master to share with him. Had this state continued, the wages of labor would have augmented with all those improvements in its productive powers, to which the division of labor gives occasion.
Okay, if you don't mind.
Okay. But this original state of things in which the laborer enjoyed the whole produce of his own labor could not last beyond the first introduction of the appropriation of land and the accumulation of stock.
Now, stock, incidentally, of course, means capital, and master is employer. Please
Okay, it was at an end, therefore, long before the most considerable improvements were made in the productive powers of labor, and it would be to no purpose to trace further what might have been its effects upon the recompense or wages of labor.
Okay, thank you. The recompense or wages. Thanks.
Recompense.
Okay, now perhaps we can get someone else to read a few more passages, starting up on the left. Okay, thank you.
Starting with as soon as?
Yeah.
As soon as land becomes private property, the landlord demands a share of almost all the produce which the laborer can either raise or collect from it. His rent makes the first deduction from the produce of the labor which is employed upon the labor.
Could you speak a little bit louder? A little bit louder, please.
It seldom happens that the person who tills the ground has the wherewithal to maintain himself till he reaps the harvest. His maintenance is generally advanced to him from the stock of a master, the farmer who employs him, and who would have no interest to employ him unless he was to share in the produce of his labor, or unless his stock was to be replaced to him with a profit. This profit makes a second deduction from the produce of the labor which is employed upon the land.
Okay, one more. One more paragraph.
Oh, one?
Yeah.
Should drink my water. The produce of almost all other labor is liable to the like deduction of profit. In all arts and manufactures, the greater part of the workmen stand in need of a master to advance them the materials of their work and their wages and maintenance till it be completed. He shares in the produce of their labor, or in the value which it adds to the materials on which it is bestowed, and in this share consists his profit.
Okay, thank you very much. Now, Smith is advancing a number of major fundamental ideas. One is that the original form of income, the original natural, rightful form of income, is all wages. Why does he say that? Well, he says all wealth is produced by labor, and then he concludes that he asserts that the product produced, or the value of the product produced, is the natural recompense or wages of labor. So from a purely physical point of view, someone makes a product, it takes his labor to make the product, Smith asserts that the product would be his wage, or if we have money, the money value of the product, that would be his wage. And so he's assuming that there's an original state of things. People are working, they're producing products, the workers keep their products, or the whole value of their products. All income is originally wages. Only laborers, only workers are getting any kind of income, and thus he concludes that all the income is originally wages. That's his claim. Anyone have any problem with seeing that? Then he's claiming further that incomes other than wages, and the two that he refers to are the rent of land and then the profits of stock, and he would incorporate interest under the heading of profits. He says these emerge only later on. Only later, when land becomes private property, does rent begin, and then the worker has to pay over what was originally part of his wages to the landlord as rent. And that's the first deduction from the wages of labor, the payment of rent. And then he holds that profit is the second deduction made from the wages of labor. First he illustrates it in terms of agriculture, but then he says this applies everywhere in all arts and manufactures. The worker needs an employer, and the employer's profit is a deduction from what was originally naturally and rightfully all wages. So I call this the primacy of wages doctrine, the doctrine that wages are the original form of income, and then the further corollary idea that incomes other than wages are a deduction from what is naturally, rightfully wages. Is there anyone who doesn't see that this is Smith's framework? So he's got the primacy of wages doctrine. Now, Marx appeared quite a few years after Smith. The Wealth of Nations was published in 1776, the year of our revolution, and Marx's main book, Das Kapital, appeared in 1867, almost 100 years later. But Marx's central framework seems to be taken straight out of The Wealth of Nations. He just has some differences in terminology. Smith refers to the early and rude state of affairs, when the workers had neither landlord nor master to share with them. This original state of things is all income is wages. There's no deduction of profit or interest. Everything is just fine and dandy. Well, Marx advances that exact same idea, that the incomes other than wage, that originally we just have manual workers, and all the income is going as wages to the workers. There's no profit, no interest, no exploitation of labor. Marx presents it in his own terminology. He has a sequence CMC, where C stands for commodity, M is money, and C is another commodity. Now, in Marx's view, he calls this simple circulation. Simple circulation. It's the same as Smith's early and rude state of affairs. In simple circulation, manual workers are producing commodity C, which they sell for money, M. And then what do they do with the money that they've sold for? Well, they turn around and they buy other commodities. Why are they buying the other commodities? They're not buying them for the sake of subsequent sales. They're buying them not for the sake of subsequent sales. Essentially, they're making just consumption expenditures. That's simple circulation. Now, in Marx's view, in simple circulation, the same as Smith's early and rude state, all the income goes to the wage earners. There's no profit, there's no interest, there's no land rent, there's no exploitation of labor. When does exploitation begin? When did it begin, according to Adam Smith? He didn't use the word exploitation, but when does the deduction of other incomes from wages start?
When you had private land becoming private property and you had to pay land rent, because that's a further deduction. as well as the profit of stock, which is another further deduction.
Okay, when land becomes private property, that's when we get into trouble. And when capital accumulates and the capitalists start making profit. According to Smith, when exploitation begins, it begins when land has become private property and when capital is accumulated and capitalists appear on the scene. Before there was private property, before there was the accumulation of capital, before there were capitalists, what income was there?
What do you produce?
Just wages. Only the workers got the income. All income was labor. The wage earners had no one to share with. Well, this deduction, the raking off of incomes other than wages from what originally, naturally, and rightfully was supposedly all wages, that only begins, according to Smith and Marx, when we get private ownership of land and the accumulation of capital and the appearance of capitalists. Now, in Marx's terminology, there's a second form of circulation beyond simple circulation, which he calls capitalistic circulation. Capitalistic circulation. And it's only under capitalistic circulation that exploitation occurs, that these incomes other than wages come into being and are deducted from what was originally, naturally, and rightfully all wages. And this capitalistic circulation is characterized by the sequence MCM prime. MCM prime. What is it, that first M?
Money.
Yeah. It's an outlay of money. For what purpose?
Buy commodities.
Pardon me?
To buy commodities.
To buy commodities, which is what is to happen to them?
To sell us.
To be sold for a larger sum of money, the larger sum being indicated by M prime. Well, according to Marx, exploitation occurs only under capitalistic circulation. It's only with capitalistic circulation that we get profit, interest, land rent, and what's the nature of these incomes in relation to wages?
Deduction.
There are deductions from what was originally, naturally, and rightfully all wages. Now notice, what does this concept? What is this first M? Could anyone relate this first M in the MCM sequence to anything we discussed earlier this evening? What concept does M represent? Not in Marx's recognition.
Capital expenditure.
Productive expenditure. Productive expenditure. M is productive expenditure. And there is no productive expenditure under the CMC sequence. Who makes the productive expenditures?
Businessman.
Yeah, businessmen and capitalists. A businessman can be thought of, or a capitalist, as one who buys for the sake of subsequently selling at a profit. That's the essential characteristic of business activity, making productive expenditures, buying for the sake of selling at a profit. And that's how Marx conceives of businessmen and capitalists too. Okay, well, where I want to start here is by pointing out how thoroughly wrong this framework is, how gross really are the errors both of Adam Smith and Marx on these points. Now with Marx, it's not surprising that he has major errors in this area, but Adam Smith is typically presented as what? In contrast to Marx. Marx is the main theoretician of socialism and communism, and what is Adam Smith supposed to be?
Most like the father of capitalism.
He's regarded as the father of capitalism. But this is pretty bizarre if you think of that. Here's the alleged father of capitalism, whose views with respect to the framework of the exploitation theory are indistinguishable from Marx. It shouldn't be too surprising that capitalism has not been so well received when its purported leading advocate shares so much common ground with its main critic. Well, let's get underway here. I want to make the point that under simple circulation, a commodity, money commodity, equivalently Adam Smith's early and rude state of society, It's utterly mistaken to believe that all income is wages. All income is received by workers, by manual workers. That's certainly true. But the actual nature of the income received is not wages. If we take Smith and Marx at their word, and we have manual workers producing products, let's put in some examples. Some are producing loaves of bread, others are producing pairs of shoes, on and on. And what they're selling is loaves of bread, pairs of shoes, etc. Well, when you buy a loaf of bread or a pair of shoes from someone, if you were asked the question, the nature of your payment to that person is A, a wage, B, a product sales receipt. What would be the answer?
B.
It would be a product sales receipt. When I buy a loaf of bread or a pair of shoes, I'm not paying somebody a wage. What is a wage? When do you pay someone a wage? You're paying someone in exchange for his performance of labor. A wage is money paid in exchange for the performance of labor. So if you owned a cobbler shop and you had an employee who was working in your shop, you'd be paying him a wage for his time. But when someone is selling a pair of shoes or boots or whatever, or a loaf of bread, the payment for the loaf of bread or whatever is not the payment of a wage, it's the purchase of a product. It's the result of labor, but it's not the payment for the labor, it's the payment for the product of labor, not for the labor itself. Okay, well now notice, here we are, that we have these workers, they have money sales revenues. They have money sales revenues. They have receipts from the sale of shoes, bread, whatever else they might be producing. That's the nature of the money they're taking in. What do they do with the money they're taking in? Did they invest anything to begin with?
No, they purchase other commodities.
No. This is simple circulation, the early and root state of affairs. Are there any capitalists here?
No.
No. No one is buying for the sake of selling. No one is buying for the sake of selling. So what are these workers doing with the money they take in from the sale of the shoes and the bread, etc.?
Buying other goods.
They're buying other goods. The seller of the shoes may be buying bread. The seller of the bread is buying shoes and various other goods. Of the two sorts of expenditures, consumption and productive expenditure, which of the two is lacking? There is no productive expenditure. There's no productive expenditure here. If we take Smith and Marx literally, no one is acting capitalistically. No one is buying for the sake of selling. We have workers producing, they're selling their products, but they're consuming the whole sales proceeds. There are no capitalists. There's just manual workers producing and selling products, and they're consuming the proceeds. So there's zero productive expenditure. All right, well, we need to approach this by a few steps. Because for some reason people have trouble with the last step. Suppose we started off and we have workers who are spending 900 units of money for the purpose of producing products which they then sold for 1,000 units of money. What would be their cost? What would be their profits? Their cost would be 900. Since their sales are 1,000, their profits would be 100, right? All right, what if these workers, instead of expending 900 to bring in 1,000 of sales, suppose they could bring in 1,000 of sales on the basis of expending only 90. What then would be their cost, and what then would be their profits?
90,000 and 910.
Okay, their cost would be only 90. Their profits would be 910, the 1,000 of sales minus the 90 of costs. All right, well, suppose instead of having to expend 90 to bring in the 1,000, suppose they only expended 9. Now what's their cost? What's their profits?
9,989 or 991.
Okay, their cost would only be 9. The 9 they've productively expended, and their profits would be 991, because they still have 1,000 of sales revenues. Okay, now what if, one last example before we reach the very end, suppose they only had to expend 0.9. and that enables them to produce products which they sell for 1,000. What's their cost? What's their profit?
Cost is 0.9, profit is 999.1.
Okay, their cost is 0.9, their profit is 999.1. Okay, where do we have to go? What further little step must we make to put ourselves into Adam Smith's early and rude state and Marx's simple circulation?
Until the cost becomes zero.
The workers are not expending anything because all they're doing with their 1,000 of receipts is consuming it. So productive expenditure is zero. What are their costs to deduct from the 1,000 of sales receipts? Zero. What is the profit? 1,000. Now, I think this is a significant finding. See, here we are. We only have manual workers producing and selling products. There are none of these dirty capitalists around, no accumulation of capital. But what is the actual economic nature of the money incomes of these workers? Is it profits or wages? It's all profit. Now, I think this is quite significant. It means the original primary form of income, even though it's received only by workers, the original primary form of income is not wages, but profit. And then later, profits are not a deduction from what was originally all wages. Originally, everything is profit. Now, what happens when capitalists appear, when some capital is accumulated, when we start to get productive expenditure? What happens when we go into capitalistic circulation?
Those would be the deductions, because those are your productive expenditures.
Okay, when capitalists appear, let's reverse our movement. Let's say we have a tiny little faint speck of capitalistic circulation. 9 is expended for means of producing products which will sell at 1,000. Okay, this is the first little glimmer of productive expenditure. Now, what will follow from this productive expenditure that comes from the capitalists? What phenomenon will now be present that was not present when we had no productive expenditure? Won't there have to be 9 of costs to deduct from the 1,000 of sales revenues? To the extent that we have capitalistic activity showing up as productive expenditure, what this means is that what the capitalists are responsible for, is the creation of productive expenditure, which shows up as costs, and which does what to profit? They reduce it. You see, originally, 100% of the sales proceeds are profit, and there's zero wages. Now, when the capitalists appear and are making productive expenditure, well, their productive expenditure is going to show up as costs, which will reduce the proportion of sales revenue that's profit. And now, what is one of the items of productive expenditure for? What is one of the major things that is purchased with productive expenditure? Labor. So what the capitalists are responsible for is not the phenomenon of profit. They're not responsible for bringing profit into existence. Profit exists before there are any capitalists. It's the original primary form of income. What the capitalists are responsible for is the creation of productive expenditure, which includes, as one of its main components, the payment of wages. The capitalists are responsible for the payment of wages in the production of products that are to be sold, and also for the emergence of the phenomenon of cost to be deducted from the sales revenues. Well, let's suppose we start off, we've gone from 0 productive expenditure, 0 wages, 1,000 of sales revenues, 1,000 of profit. Now we have 9 of productive expenditure, which might include perhaps 4 of wages and 5 of expenditure to buy capital goods. So now we have costs that will show up as 9, and what's happened to profits? Profits have fallen from 1,000 to 991, and what's happened to wages?
They got there.
What's happened to wages? Where were they and where are they now?
They were at 1,000, now they're at.
There were no wages.
There were 0 wages. There were 0 wages, and now there's 4 of wages. All right, let's suppose we go further. I guess we might be able to work it here. Our initial situation in the early and rude state, that we take a ratio of profits to wages. Well, originally, the whole sales proceeds are profits, because there's no productive expenditure, no cost, and no wages. So the ratio of profits to wages is 1,000 to 0. That's infinite. All right, now let's start assuming we have some productive expenditure. Suppose we've imagined we have 9 of productive expenditure. Well, with 9 of productive expenditure, profit is $9.91, and wages are 4.5. So maybe I need to modify this. Okay, so the ratio of profits to wages at this point, instead of being infinite, 1,000 to 0, it's 222 to 1. Now, what happens if the economy becomes more economically capitalistic? Productive expenditure goes from 9 to 90. And we'll assume that the wages are half of that. So where do we stand now? Okay, wages are 45, and what's happened to profits? They're 910, and now if we still keep going further, suppose we finally get to the point we have a very highly capitalistic economy. We'll use Marx's own concept of capitalistic circulation, CM prime, and we're expressing the economic degree of capitalism in terms of the ratio of the first M to the M prime. An economy is more economically capitalistic, the greater is the buying for the sake of selling relative to the sales proceeds. We're assuming the sales proceeds are 1,000. The buying for the sake of selling, we've followed from 0.9 to 9, now to 90, and now we're going to go to 900. An economy with 900 buying relative to 1,000 of sales revenues, 900 for the sake of earning the sales revenues of 1,000 relative to the 1,000. What kind of economic degree of capitalism is that? Well, that would be a much higher ratio. It's 900 to 1,000. Okay, what's profit here? It's reduced to 100, and wages are 450. And now, I don't know how I have, I see, I'm continuing with 1,000. I need to change the value. It shouldn't be 1,000. It should be whatever profit is. So profit is D 110. Okay, so now profits relative to wages are just 0.22. They used to be infinite. The main point here is what's happening to the relationship between profits and wages the more economically capitalistic the economy becomes.
Wages increase, profits.
Wages increase, profits decrease. Now, to look at this in a very closely related way, contrary to Adam Smith and Marx, what the businessmen and capitalists are responsible for is not the emergence of the phenomena of profit. They're not responsible for the emergence of the phenomenon of profit or for its deduction from what was originally and naturally and rightfully all wages. On the contrary, what they're responsible for is the emergence of the phenomena of productive expenditure, including the payment of wages in the production of products to be sold, and the creation of costs to be deducted from sales proceeds, which were originally all profit. They're actually responsible for the reduction of profits as a fraction of sales and the positive creation of wages. And the more economically capitalistic the economy, the higher become wages relative to profits. Does anyone have any problem seeing these points? Let's work an example. Okay, here we are. We have an example. A problem to test your understanding. Can you see this in the back? Anytime anyone is ready to start answering the questions, let me know.
Number 1 is 0.
Number 0.
Okay, at least two students are saying number 1 is 0. Anyone think it's 1,000? Yes?
I would say it's 0.
Okay, 0. Any other answer? Very often I ask this question, do people answer 1,000? It is 0. It's 0. If you answer 1,000, you're thinking in terms of Smith and Marx and the confusion of product sales revenues with wage payments. What about number 2?
0.
0. Again, 0. There are no wages paid in the production of products for sale unless there's capitalists. Number 3.
0.
0 again. Number 4.
1,000.
1,000. Number 5.
0.
0. We haven't discussed that explicitly, but if there's no productive expenditure, what would be the nominal value of any capital assets?
1,000%.
If you haven't spent any money to buy assets, what's their value? 0. Well, what's the rate of return on capital? We have 1,000 of profit and 0 of capital.
0.
Pardon me? Infinite. So we start off in the early and rude state of society, the rate of return on capital is infinite. What's the effect as the economy finally develops some economic degree of capitalism?
You get productive expenditure, the payment of wages, and cost of production.
Which serves to, on the one side, reduce the proportion of sales, which is profit, and also what is productive expenditure acquiring?
Labor.
Well, it's acquiring also capital assets. So you no longer have capital assets as 0. They'll be the greater, the more economically capitalistic the economy is. So imagine we have a situation, profits in the economy are 100, and the total value of accumulated capital assets is 2,000. What is the rate of return on capital?
Can you say those numbers again? I'm sorry.
Profits are 100, and accumulated capital is 2,000. What's the rate of profit on capital?
5%.
5%. So we've gone from infinity down to 5%. And if we use the same numbers as before, if productive expenditure is 900, half of which was wages, well, then wages would be 450, and profits 100. Profits would equal only 22% of wages. All right, well, the point is capitalists don't deduct profits from wages, and this is point 3. They do not deduct profits from wages. To the contrary, they create productive expenditure, wages, and costs, which reduces the profit share and raises the wage share. Well, I think this makes a good logical temporary stopping point. When we return from the break, we'll see how these points apply further in our own economy and clarify the nature of the activity of the capitalists and the nature of their rate of return. So let's take a 25-minute break here, and then we'll resume at this point.